Hey, this is Dr. Jeffrey Scott, and this is my weekend market update. I'm doing this on Friday, January 30th. What a day in the U.S. markets. Maybe we could have seen it coming, but what a day. I've been doing this for a long time. Bottoms usually occur over one day, and or can occur over one day, and they're usually an event, like we saw April 7th. Tops are often a process, and you've had to question whether or not we are in a topping process. And then we know so many things were crazily extended: gold, silver, uranium, platinum. Oh, yeah, don't forget memory disks. I mean, so many different things. And then today felt like a liquidation day. So is this the beginning of something new? Are we about to enter a bear market? Is it time to run for the hills and go short? Or could this have been caused by other things, such as the government shutdown, the naming of the new Fed head, and the strong dollar? Well, let's take a look at the markets. Again, my name is Dr. Jeffrey Scott. I am the market MRI Pro at gmail.com. My Google group is called Top Down Trader, and my website's marketmripro.com. This is for educational purposes only. Anything I talk about should be taken in the spirit of education, not investment advice. The intent of all my videos are to show you how I use my tools for top-down analysis. Trading involves risk. You alone are solely responsible for any investment decisions you make. I may own or intend to buy, sell, short anything, any stock mentioned in this report. Trading stocks and options should be considered risky. You should always consult with your financial advisors. And I have tools in multiple platforms, but I'm an independent trader. If you're looking for the wealth charts video, I will be doing it Sunday evening. Typically, I do that one after the futures come out, so I can see what else there is to add from the one that I do for the broader um, public. My Google group is called Top Down Trader. If you join it, you'll get early notification when I post things. You'll get invited to member-only groups. If, for example, you come to the mentoring tomorrow, you don't have my product, but you're a member of Google group, I'll give you an extra $100 off the product. So there's some reasons to come, and you control your participation in the mailing list because you sign into Google Groups. You go to all groups, you click join, you find Top Down Trader. Then you tell us how to contact you, and you just reverse the process if you want out. So what have you got to lose? Is there a recession in the near future? Well, there's always a recession after the yield curve crosses over the zero line after it inverts. Every time going back to the 80s. You invert, recession. You invert, crossover, recession. Crossover, recession. Crossover, recession. Well, we've done the same thing here. Don't you think it won't be different this time? I don't know when it's coming. And then we look over here, that's a 10 minus 3 month. You look at the 10, 2 years, you see the same pattern. Yield curve inversion, cross over the zero line, and you end up with a recession. If you look at the Bank of America high yield index option adjusted spread, something you might expect to spike if we're going into a recession. It's not moved, so that's good. And if you look at it's now from a couple weeks ago, but the Philadelphia Diffusion Index is positive, which you don't get in a recession. Usually recessions start when you're below minus 20. So I put all that together. I go, yeah, there will be one someday, but it's not coming this week. What is coming this week is a lot of employment data. We got the ADP, so the private world, on Wednesday. We got jobless claims on Thursday. We got Atlanta Fed Bostic speaking. And we've got the employment complex on Friday with a preliminary consumer sentiment. You got some earlier stuff in the week. Some of it's old data, some of it's new data, auto sales, ISM, job openings. But I think the big thing is going to be the Friday monthly employment report. What we also have is a zillion earnings, and it doesn't take rocket science to see what's going on. You've got to beat earnings, you got to beat revenue, You got to have good projections forward, and you better be careful if you're a software company and your capex is high. It's simple as that. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So what do we got to come this week? Well, little companies like Palantir, PayPal, AMD, Supermicro, Amgen, Chipotle, Uber, Lilly, Alphabet, ARM, Qualcomm on Wednesday. Thursday got Amazon, Iron, um, Bitcoin miner turned data center power generator, the strategy companies, Roblox, and then CBOE, Biogen, a few others on Friday. It is a busy, busy earnings week. So the quote is very important. It is a judgment call to hold stocks over earnings dates. It is bad judgment to not know when your stock's earnings date is scheduled. I am doing that free mentoring session tomorrow. Um, My wife gave me the day off, which for various reasons. So I will start at 10 a.m. It usually goes 3 hours, sometimes longer. Spots are limited. I'll have a registration link in the remarks section below. And my agenda is top-down investing, how I analyze the markets, sectors, industry groups, and stocks, some of my favorite scans, and how I use options as stock replacement. I will demonstrate the things that I did in 2025. And those that follow me know that they've seen my balances, that I had 183% return, which is good. But more importantly, I do it while leading a division in a large company, working full time, and having a family. So the key is, to me, you can be successful trading and not be at your screens all day. And that's what I like to talk about and teach. For more information about the things that I do, marketmripro@gmail.com. If you have the program and you're having any technical issues or installation issues, you forgot your username and password, coding@marketmripro.com. On to the charts. Let's see what we got. This isn't going to be a long one because I don't think I'm going to sit here and show you a lot of stocks to go long on. If you look at daily performance, the dollar was up almost 1%, closing at the high of the day. Is that defensive? Is that the new Fed head? But it's a big number. The VIX was up only a little bit, surprising. Bitcoin was only down a little bit. That too was surprising. On the week, it's down over 6%. The diamond's down 0.24, spider's down 0.3, the Q's 1.2, and the Russell down 1.41. Now, before we get all nervous and upset about how bad of a day it was today, look at the 5-day change. The Russell down 2%. All right. Q's down 0.14, the spider's up 0.4, and the diamond's down 0.39. I think what we had here was a massive rotation that kept the indexes close to break even, but changed what's in leadership now and really punished the recent leaders. Proof that the breadth change, if you look at the new highs minus new lows at 12 months or 52 weeks, we went from almost 200 a couple days ago down to 31 in the NYSE and over 100 down to minus 48 in the NASDAQ. We've had multiple days of participation well below 50%. If we look at the three major indexes and we consider putting them into their sectors and industry groups, you could see in blue was Fridays, green was Fridays, the white, beige, whatever it's on your monitor, was the prior day. You can see we had much less positive sectors and industry groups. We could see participation in the S&P 1500 was 45% was up, 33% was up on the NASDAQ, and 37% on the NYSE. So when more than 50% of the stocks in the market are down, odds are you've got some negative performers in your portfolio. If we look at what was working, and this would be looking at just the S&P 500, leadership was consumer staples, energy, healthcare, communications, and real estate. What does that sound to you? It sounds to me like we rotated defensively, big time. What was the laggards? Laggards were technology and materials. things that have been leading. If we look at themes, the only themes that were up were telecommunications and oil exploration. Retail was kind of break even. Now, what was down? Whoa, look at these numbers. Almost 15% negative on silver. And that means for 5 days, it's been down 15%. What happened to the rocket ship? Gold was down 12.74. Copper 10%, uranium 7.3, metals and mining overall, the stock 635, 4.99 for lithium, video games 4.68, and then between 3 and 4% down blockchain, solar, semi, social media, autonomous driving, and so on and so forth. It was a bad day in the U.S. markets, any way you look at it. Now, where are we going to go? Well, I have a very objective way of looking at that. Let's go to my timing model. Here are weekly charts. Now, my timing model involves a trending indicator. Blue is an uptrend, red is a downtrender, a WMA, and the first day that you cross above the WMA and your trend is blue, the first day that happens, that you start in an uptrend. The first day that you cross below and it's red above, you're in a downtrend. And down here for some, oh, I don't know why it's so, there you go, that'll fix that. You can actually see, that's bizarre down here. There's something not functioning right. Let me just try something here. Go to daily. Let's go back to weekly. There we go. So here is the weekly spider, Russell, Qs and diamonds. And you could see the day it crossed above, it blew here, it went to green. We've been in a buy signal on my weekly, the slow timing model, since May 12th. We are in a buy signal on the weekly of all 4 ETFs. If I look at the monthly, the really long term, we're in a buy signal on all 4 ETFs. If I go back to that weekly and look at the charts, so just a little bit. Again, how bad does this spider look? We set an all-time high this week. We had a doji after a little bit of a pullback. That's indecision. We could still go higher. It's not the end. Could be the end. It's probably not the end. If I look at the Qs, we're just going sideways. Yeah, I don't like this candle. It's a shooting star. But we were hardly down at all this week on the Q, and we're in a consolidation. We're still in a buy zone. If I look at the Russell, all-time highs were yesterday. How bad was it, or was last week? How bad was it this week? Well, we have a reversal candle perhaps, but we're 1 week off all-time highs. And then you look at the diamonds, it's the same thing. So before we hang the crepes, get the casket ready, and bury the bull, I'm not sure it's any different than many of the other pullbacks we've had. Now, here's the counter. I look at the dailies. What you see is the spider clearly in a little pullback, and we're going to look deeper with the rest of my indicators in a minute. The Qs pull back, Russell's pull back, they've all pulled back in the short term. They're all within, except for the Qs, the highs are back here. They're all within a short period of time from their all-time highs. So again, is this a horrible looking market? It might be. And why do I say it might be? Because the Qs, the diamonds, and the Russell have all gone to a sell signal. So I will sum up my feeling about the markets, and we're going to look at a lot of other things, is that we're in an uptrend under pressure, and I'm concerned enough that today was a defensive day, a day to start thinking about taking things off the table, protecting them with puts, and money management, because as I like to say, I make the most money off bottoms when I want to go all in, but you got to have cash left. And frankly, I lose the most money of my cycle at the tops because I'm too overloaded and stay too long. Well, I started addressing that today. If we look at the index ETFs, we're going to look at the daily charts here. So we start with, let me just tell you what's on my charts. The green is a 17 simple. The light blue is a 21-day EMA. Why? Because I think Mike Webster's a genius, and he always talks about the 21-day EMA. I've got a 50 in white, and I have a 200 in red. And after we started pulling back into the 100 here, I put the 100 on the charts as well. So seasonality is still our friend. And then when we get into the middle of February, it looks like, at least on the spider, we might expect a little bit of a soft patch. So taking profits out now, building some cash might be okay. If you look at these 2 days, and they were interesting days to watch in the market, big spidery legs coming down. And then they closed up closer to where they opened and closer to the high. So yes, bad couple of days for the overall markets. Really not that bad for the index if you look where they closed. We are sitting with a doji above the 17 on the spider. I think this market, that's indecision. The market could go either way. I am concerned enough that I raise cash. I haven't gone short. The Qs, I could say the same exact story. Maybe do okay for a couple more days, and then you get to the middle of February, and the markets seem to sell off. So that's something to look out for. You'll notice a pullback to the 100-day, just short of the 100-day, 100-day. Well, our spindly legs got down to the 50 here. We closed between the 50 and the 17 on the daily Qs. Looks a little worse than the spiders with the pullback to the 50, but it's not broken down. The diamonds. How many dojis in a row do we need to say that there's tons of indecision here? Perhaps a little bit more strength and then weakness in the middle of February for a while. Where did we close? Just under the 21-day EMA. Spindly legs. The market keeps rejecting the sell-off and closing back towards where it opened, giving us dojis. Those are indecision bars. Could this market sell off more? Absolutely. Will I let it get much further than today's lows or that 50, which is rising? I would not. But I'm not sure I'm ready to hang the crepes. And then the Russell, same thing. Seasonality is okay. And then in the middle of February, it weakens. Looks like around the 17th. We broke below the 21-day EMA and we turned to a sell signal today. So there's enough here to be concerned about. But pullbacks to the 50 occur all the time. Apparently, pullbacks to the 100 occur more than I usually look at. So this was a sell signal right there. We talked about the high jump being 100. And like clockwork, it came back down. I'm not convinced it's going to go all the way down to the 50 or the 100-day moving average. However, I'm old enough that I worry about my retirement, and I'm playing my retirement money when I invest, so I'm not foolish enough to be all in right now. This is something that's been bothering me, and I talk about it every night. Well, first of all, you notice the seasonal strength in the VIX. That goes along with the seasonal weakness of the market. That's not a surprise. But explain to me this business here that we're in an uptrend in the VIX, even though the markets were at all-time highs. That doesn't fit. That worries me a lot. It really does. This is where the VIX should be if the market's happy. And this is where it was for a prolonged period of time. We don't usually see, unless we're about to take off and have a lot of damage, that type of a trend line. So to me, that's still worrisome. And if I look at the dollar, yeah, the dollar had a super strong day. I think a lot of it did have to do with the new Fed head being announced. Not much seasonality in the dollar, well off the highs, and I doubt that this is the reason why all the metal complex sold off, but I'm sure it was factored in to the other issues. Speaking of the metals, let's take a look at commodities. And boy, were they interesting today. Gold, major sell-off, down over 10%. Um, had massive range the prior day and closed just above the prior high. And it just broke down, very predictable, and you could see big volume. You had a CPR sell, gap down, volume, just so much going against this. Is it a climax run? Well, it looks like it now. Silver, same story, even more down, 28.59. Now, does that mean it's not going to go up and set all-time highs again? It could, but after a 28-day sell-off in one day, I don't think that's going to happen right away. I'd like to see it base a little bit and at least do kind of a sideways movement that it did here. And I wonder if the market started selling off late morning and early afternoon because of margin calls for people that were the last ones in and thought they'd margin up because they couldn't lose. Well, the strength now is oil. Oil's had a clean breakout. Oil has good seasonality for a while here, and we'll see that when we look at some individual stocks. Natural gas has also broken out, and we'll see how high it goes. It's obviously well off of its highs. 10-year didn't do much today. 10-year was plus 0.38, and the 30-year was plus 0.43. I'm glad we didn't see a spike because if the bond um, experts, the smart money in the markets, did not like the Fed president, they would have spiked the yields on the 10 and the 30. So that's a good thing. If we look at the buckets, speeding things up, we've shifted far to the left, which means except for maybe the NYSE, we're starting to grow the stocks below the midline of the Bollinger Bands, turning more bearish. The biggest number of stocks below their bands, 14% on the NASDAQ, 10% on the Russell, 9% on the S&P 1500, 10% on the NYSE. None of those are I have to reverse now numbers. Could reverse on Monday, and maybe we'll get a little bit of a reprieve, but that's not a guaranteed market reversal signal. I'll show you some other concerns. Market breadth. So we confirmed our Hindenburg omen today on the NYSE, and oops, it came out after I finished yesterday. This is one of the last things that gets calculated. We need a lot of data for that. So we've got confirmed Hindenburg omens on both the NYSE and the NASDAQ composite. I pay attention. Hindenburg omens occurring at tops, especially tops that are stalling, are meaningful to me. The left is the NYSE, the right is the NASDAQ composite. Stocks above new highs, stocks above the moving averages are coming down on both, but not very negative. You could see the the new high, new lows still positive here. And look how positive they've been for some time on the NYSE. They've gone negative on the NASDAQ. The AD lines are negative on both, and the up-down volume is negative on both. And then this is the 13-week new high, new low. I look for extremes. At extremes, you get reversals. At extremes, you get reversals. And we are 0.53 and 0.26. We're not at extremes. We're getting closer on the NASDAQ, but we're not at an extreme right here. Ratio charts, I look at what's strong in the market, and we can see materials, communication, energy, staples, industrials have been leading. What's been lagging? Well, financials are turning up. Technology has weakened. Discretionary has weakened. Healthcare has weakened. If we look at my expanded market breadth, and what I really like to focus on here is that 13-week new high, new low indicator, and just see where they are. So on the Spider, it's at 55. On the S&P 1500, it's at 58. On the NASDAQ, as we know, it's at 26, and it's at 49 at the Russell. So it's down on all of them, but it's not triggering any type of a signal. I like to look at the sectors and see how they're performing. So I actually combined what I look at on a stock chart and the timing chart on each of these. So let's just go quickly. Bitcoin, no good. Bitcoin continues to break down. Eventually, it's going to stop falling. It's kind of in a double bottom area here. Maybe it bounces on Monday, but Bitcoin has been lagging. Technology broken down below the moving averages. The yellow is that buy sell signal component, and you could see it's gone to a sell signal and breaking down. Discretionary has also broken down, but it's not broken down yet below the 50, but it's in a sell signal. Communications, this is a place that we run to when it's risk off because you've got stocks like Verizon, AT&T, Charter that pay dividends and are kind of safe havens. And you could see yesterday all the blue dots that came in, a big breakout on communications. Yesterday being Thursday, it's still Friday. Here we're looking at industrials basing up after a nice run, still look very healthy to me. Technology has broken below the moving averages, is in a sell signal. Energy closed today up 1.07, which was interesting because this looked like a reversal candle yesterday. Is it a safe haven? Perhaps. And there's still saber rattling going on with Venezuela, Iran, and others. Materials kind of look like they were rolling over, but before I write them off, they've got a doji, and they're still in a buy. So I think this one could go either way. Real estate, this should be a defensive play. It's kind of neutral here. It is in a buy signal, just above the moving averages. And then utilities, typically these are things that people like to buy in time periods of concern. But there's a problem with utilities now. Not really a problem, but there's a change in between the utilities of old. And that change is a lot of them are involved in the powering of data centers. And if data centers fall off, then LEU and other utilities are going to take a dive. So the utilities are kind of mixed here. Staples, well, another defensive. I mean, Kimberly-Clark, Colgate-Palmolive, Tootsie Roll Company. I don't usually buy those things, but some of their dividends are getting impressive, and those are defensive. So is Big Pharma and MLPs. Speaking of pharma, healthcare doesn't look very healthy. Had a nice day today, so sort of a safety move, but it's still in a sell below the moving averages. And here's Bitcoin again, so I know I've made it through. And then I also like to look at some of the our favorites, things that many of us have ownership of in our accounts. And this was not a great week for a lot of these stocks. So let me, whoops, hit the wrong thing. Let me hit this. Let's go through. Amazon, earnings are out this week. I kind of call it neutral. It's still in a buy, hasn't broken down, and we'll see if it acts like Meta or it acts like Microsoft with earnings. Apple has broken down, but it's fighting to get back above the moving averages and actually triggered a buy signal. So maybe Apple's interesting here. You got that 50 overhead. Google, Alphabet's been the big guy leader, and it was did okay today. It was pretty flat actually, closing down 0.04%. Meta, massive earnings beat. Wall Street loved it, traded off a little bit today, but interesting, it was down almost 3%, still was an inside bar and above the gap. I think Meta still looks interesting. Not Netflix. Someday Netflix will bounce, but it'll probably be after they figure out what's going to happen with them and Paramount in their fight over Warner Brothers. And then Tesla, I thought Tesla was going to run here, and it just has struggled. Tesla, I don't know to like it or not. One of my favorite cars I ever had was the Tesla X. I love driving it. I love the gull-wing doors. It was kind of Spartan inside, and I trade cars all the time. I went to a Lucid after that. But I bought the Tesla because somebody had an S. and I love that car. Problem is, Tesla just announced they're not making the S's and the X's anymore, and they're going to start doing robots and other things in the factory. What does that say about Tesla and electric cars? I guess the threes and the Ys and the upcoming twos are going to make up for it. And people want cheap electric cars. Nvidia actually had a pretty good week, closing just off the highs and down less than 1% on a horrible day in the U.S. markets. Still looks good. And then Mr. Softy, oh man, what a tease. We could have just taken this line and continued it here and never bought it, but I bought it. Now, fortunately, I bought puts, but I still didn't have a great week with Microsoft. Ouch. If you're a software company, you better have a way to monetize your CapEx and your AI spend, is that message there. Biotech, boy, it's been loosey-goosey here. Is it breaking down? It might be. Maybe we'll have an acquisition of somebody over the weekend and pop it up. But I think biotech is suspect at best. And if you're still holding a lot of LABU, just think of what happened with silver and gold today. That can happen with biotech on Monday. So lighten up your LABU is what I'm thinking of doing. Now, by the way, none of this is investment advice. I'm telling you my mental thoughts, and I'm really referring to me of what I'm going to do or what I'm thinking. I don't know your personal financial situation. I don't know how much money you have, how much risk you're willing to take, or your financial goals. So I couldn't tell you what to do. But for me, it was time to start raising profits. This was one of my big runners and place to continue to take profits from. Now, pharma here doesn't look good. Yet, Merck was one of my favorite stocks on my review tonight. So pharma is defensive. Why? Because some of pharma pays a big dividend. So I might still be looking at pharma. Data centers, big sell-off today. Not as bad as gold and silver, but still down almost over 2.5% after being down yesterday a 0.5%. So kind of a reversal. I don't know if not really a climax run, but looks like data centers may have topped for right now. And then lastly, ITA. This was one that looked really good. And, fortunately, I did play HWM better than I played Microsoft, and I was able to lock in my profits with some puts that I had bought when it spiked higher. But ITA, does it bounce here or does it break down? It could go either way. So that's a quick run of some of the leading stocks, some of the sectors I like to watch more closely. And now let me just finish by going into the JS layout. I'm going to do two things. I'm going to go into the top-down view. And what's really great is we got 3,800 stocks here, all of them in sectors and industry groups. And I'm going to do something a little different today. I want to look what's performed the best over the last 5 days. So I'm going to rank it by a 5-day momentum. And I'm going to take just the top 10. Actually, before I do that, I'm going to go over here to the sectors, and they're ranked by 5-day already. And I'm going to take the top 3, staples, utilities, and energy. That gives me 464 stocks, but I only want the top 10. 2, 3. And look what we have here. Utilities, oil, gas, packaged foods, household and personal products, beverages, grocery stores, MLPs, specialty retail, and tobacco. Can you say defensive? And then let's take a look at some of the leaders. Let's rank this by FM5 as well, which I already did. And let's just take a look at some of them, maybe the top 10. GEV earnings are out. This is an earnings machine spinoff from GE. Look at the surprise percent. All right. Does anybody actually believe it would do $1.84? No, they raised estimates going forward. So it's an earnings machine. It is a revenue machine. And it trades at a multiple that's high, as it should. Does not pay much of a dividend when you consider it's a $700 stock. I like this one and sort of had a cup breakout, another cup. I think if the market stabilizes, this is going to be a leader coming out. JBSS, what is this? John Filippo Staples. I can always highlight it and tell me what they do. Tree nuts and peanuts. Well, that's exciting. Breaking out here. Does it have a dividend? So earnings came out, 13% growth. PE is 11, plays a 3.32%. Safety play. Pays a dividend. It's not overpriced compared to growth rate and multiple. Um, all right. Chevron, one of the leaders in the integrated oils. I believe their earnings just came out today, $1.52. Now it's not growing, and neither is their revenue, but they are looked at as a, we'll come back to that in a second, a darling, and they're the leader, I think, of the integrates. Now, the interesting thing here is it says it pays $6.84, but 0%. So I would check the dividend in another source. All right, what else do we got? Colgate Palmolive. No, it's boring as heck, right? But a nice breakout. Seasonality is okay. It's heading up on all of them. And 95 cents will be against 91, so minimal growth. Pays 2.41%. It's just not my kind of stock. Pepsi, another staples, breaking out. Mark's Company, more staples. Church and Dwight. Um, a lot of things that are in your medicine cabinet. I don't know why it won't come up. Let's try that again. Here's Church and Dwight. Earnings came out. Little bit of a beat, little beat on revenue, pays a 1.41% dividend. Exxon also had a strong session today. Considering the negativity in the market, anything that was up today is remarkable. Earnings came out, $1.71, minimal quarter-over-quarter growth, but a little bit of a surprise, and it pays a 3.61. So you get in a sense of what's working right now. Boring stuff, stuff that we wouldn't usually be looking at. So I'll do a much deeper review tomorrow during the mentoring. But the other thing that I like to do, and I did find something I liked on the impulse, is I'll just take a bottoms up approach and run my top two scans. The 8 plus scan looks for what I call double momentum buys. It had two. Yesterday I talked about regional banks. Regional banks held up pretty well today. This is Axos Financial, a Vegas-based regional bank, and it's in a nice uptrend, had a pullback to the 17 and a breakout. Earnings are out, growing at 21% this quarter with a multiple of 12. Does not pay a dividend, but you had a surprise on earnings and on revenue. I liked Axos Financials. And then the other scan I'll show you is just the A scan, which is my pullback and uptrend scan. And what I noticed in here was Merck. So the requirements of this scan, earnings are February 3rd coming up, 3% dividend. The requirements of the scan are you have to be in a squeeze, either have to have momentum or breakout or both, which they have. The relative strength needs to be breaking out, as is OBV, and you're not extended. And Merck is kind of even sort of breaking out of a little bit of a flag. So I like Merck here. And then what I thought was interesting is Korn Ferry is an executive search firm, actually breaking out over above their 200 with volume, breakout, momentum, a squeeze, good relative strength in OBV. Robert Half International is another search firm. Now I kind of thought we were talking about the fact that we had a weak employment situation. Well, I guess not. And maybe it's because there's nobody looking for jobs, because why are the search companies all of a sudden doing well? And then if a lot of the retail apparel look good, um, they say people are spending money, then does that mean the malls are going to do okay? And you got something like Simon Property Group, which based for a long time and broke out, good seasonality. And if we look at it, it pays a 4.71% dividend, trades at a multiple of 13. That's another thing. So I think the world is about defensive. And MLPX, I think, is the ETF. I like these because they're energy, but what I really like about the MLPs, let's see if I don't get fundamentals on that one. So let's just look at Kinder Morgan, one of the two that I own. These things have broken out, and most of these things pay a little bit of a dividend. This one pays 4.2%. So banks, pharma, regional banks, pharma, REITs such as Simon, MLPs, might be defensive places that are look interesting. I'll see you tomorrow at the mentoring session.